Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Ross with Victory, and today we're going to talk about the fact that as we enter into the Thanksgiving holiday time, markets have certainly been off and running. And so this has been a much appreciated change from the previous two videos that we've been doing. As you know, we have been in the midst of fairly significant corrective process between specifically the NASDAQ and the S&P 500. And so since that time, we have seen some very strong moves in the markets. And so today I just want to kind of get into some of the reasons for why we're seeing those moves and kind of what you guys should be thinking about as we see this. And so back on November 1st, I wrote a blog just talking about the fact that we were officially in a double-digit correction. And so double-digit correction simply meant that two of our indexes had seen declines of over 10% from their previous highs. And so, when I wrote this, we had been really under pressure. So coming into August, remember, I was sounding the alarms. Hey, we're very overbought right now. We're overstretched. We've diverged from all of our moving averages. This is not sustainable. I expect to see some sort of a pullback at a minimum, and so certainly we began to see that as the summer kind of came to a close. September and October were very weak months for the market, and so by November 1st we had reached that 10% decline. And so I wasn't really sounding alarms necessarily in that article. Matter of fact, I was trying to give investors kind of some perspective that in the following months, typically, we see an average 8% return the month after we officially hit correction. And so that was supposed to be good news for markets. And so that appears to be playing out pretty well so far. Right now, just 15 days into November, the S&P 500 is up just over 6%. The NASDAQ is just up over 7.8%. And so that 8% number actually seems like it could be a very realistic, kind of feasible goal for markets to hit by the end of the month. And so I want to be able to kind of just show you what some of the news has been, though, which has caused some of the reverse moves that we've seen. It's really been focused around a lot inflation. And so inflation numbers, we saw the best moves in the market since April on Tuesday of this week, after our inflation numbers came in better than expected. And so our CPI prices remain unchanged from the previous month of October. And then core inflation year over year were the lowest that we've seen since September 2021. And so you can just kind of see this in a graph. So we kind of peaked back here in 22 and we've been trending down since. But remember, there's been a lot of pain in order to get us to this position here. Those interest rates that the Federal Reserve was very aggressive in raising, and so it's caused, a lot of backlash behind the scenes. And so what investors are betting on now is that based upon the fact that we've had inflation numbers beginning to cool, as well as last week jobs numbers were a little softer than expected. This is actually good news for markets, believe it or not, because again, it's a sign that maybe the Federal Reserve is going to have to kind of pull back the reins on interest rate hikes and maybe even begin to start discussing rate decreases as early as next year. And so that has been one of the reasons why we've seen markets kind of be able to have some room to run here, because interest rates and inflation has weighed very heavily on investors this year. And so you'll remember, if you read my article, and if you haven't read it, I actually recommend that you go back, because I think it's important for us to kind of have the right framework. Now, kind of coming into the end of the year, that tends to be a seasonally stronger period of the year. October and September and August, usually the summer months coming into the fall, typically tend to be weaker. So that certainly played out this year. And so with the S&P 500, you can see this was back October 31st was right here. November 1st was about right here. So when that article came out, you'll remember that I said the fact that while corrections are often painful to endure, we often can see healthy recoveries when we have a sharp sell-off like what we did here. A lot of times they'll actually recover just as sharply, like a V. And so you can kind of see we made that V shape very nicely here. Our 50-day moving average, which is just that average price for the last 50 days. For the S&P 500 has acted as a nice line of support for us here. And so if you look at the NASDAQ here, again, you can see our V where we had that a sharp decline, and then we've been able to recover above our moving averages again. And so I think that this just played out well. And so while I didn't know specifically that this is what was going to happen, it is a good reminder that despite all of the noise that we might hear as investors, it's easy to kind of get sucked into the headlines. It's really important to kind of know what we're looking at, because a lot of times you can kind of make an agenda fit your chart, however your chart is. So I think it's important to be able to look at the data, kind of take a step back, because anytime that we trade from emotions instead of using intellect, a lot of times it doesn't have the results that we're necessarily looking for. And so it's also, I think, a good reminder of the fact that stock markets are not always going to go straight up. Markets go up and down, and it's kind of like taking a yo-yo up the stairs. The yo-yo is constantly going up and down as it gradually makes its way up the stairs, and that's the way stock markets work. It's all part of normal market cycles. We expect to see a 10% correction every 8 months within the major indexes, but we kind of forget that when we're in the midst of a correction, because at that point it seems painful and scary, even though we probably just went through this less than a year ago. And so I think that this is just kind of a good time to remind ourselves of that. And I think it's also an important time just to kind of discuss some other rules, so that things that we should be kind of thinking about as we come into, or we're coming even out of a correction right now, making sure that our portfolio has specific roles and responsibilities. Those allocations shouldn't be there by chance. There should definitely be a reason for why we have them. And another rule that I talked about specifically in the blog was the fact that if you felt really uneasy in the month, particularly of October, if you were anxious and you were checking your account and you didn't like it, that could be a sign that you're invested a little too aggressively. So if you're invested for a longer time horizon, it's important to remember that these ups and downs, that they're going to happen because markets don't go straight up. But if you were really feeling negative about that, then this may be a good time to consider repositioning your portfolio, especially after this run that we've just had over the past couple weeks. And so back when we were kind of at the bottom of that V, and we discussed in the blog also the fact that sometimes we can use corrections like that as a better buying opportunity. And so we did just that. We had some cash on the sidelines for some clients who didn't want to put all of their money into the market at once, and so we did something called dollar cost average, and we put some additional cash into the market right kind of there, because it just seemed like that could have been a better opportunity. And so as we come into the end of the year, we have a lot of things kind of going positively for the market. We have the fact that, number one, we kind of just came off of this corrective process. We have inflation numbers that are a little more reassuring, but we're also coming into the end of the year where portfolio managers are going to have to window dress their mutual funds in order to prepare for the beginning of the year. And by that I mean they have to kind of have their funds kind of repositioned back to whatever their targets are. And so they're going to wind up buying some equities to reposition. And so we also, a lot of times at the end of the year, we see investors kind of tend to come back in, especially if we've seen strong moves, maybe wanting to get back into the equity business by the beginning of the year. And so those are just things that could be going positive for the market. Again, we're never trying to time the market. We're only trying to kind of trend it. So as you remember, DALI, Dynamic Asset Level Investing, helps us to kind of just be able to trend the market. And so just based here, I'm just kind of going to go through what the leadership is. We have commodities, international equities, and domestic equities all in a very tight race here. And they're all within a couple buy signals of each other. And so what happens with DALI is that every day, every area of the market essentially arm wrestles each other, and over time patterns develop, and you can see who the winners consistently are and who the losers consistently are. And so it just gives us kind of a picture of areas of strength versus areas of weakness. Areas of strength would be commodities, international and domestic. Areas of weakness right now would be bonds. And so we can also look at areas of strength in domestic would be large cap growth, technology, industrials, large cap blend, energy. Areas of weakness right now in the market would be areas like real estate and small cap growth. And so again, we use this in conjunction with a lot of other different just technical and fundamental reporting that we look at pretty consistently. But this is just kind of like an easy way to kind of see where everything is. And so that's really what I wanted to get into today. Again, it's kind of been an interesting couple of weeks. It'll be very interesting to see if these moves that we've seen so far for the first 2 weeks of the month are able to hold. I expect that we may see a little more exuberance continued in the market. I also won't be surprised coming into next week, especially the week of Thanksgiving, if we begin to see things kind of cool off. That week of Thanksgiving tends to be a pretty slow trading week, so there's not a lot of volume that happens there. I don't really expect to see crazy moves next week in the market, but right now we are a little overbought after some of these moves, so I would not be surprised if we see a little bit of pulling back or for the markets to cool off a little bit. Then as we kind of come into December, we'll be waiting to see if the Santa rally is going to make an appearance. I'll be talking about that next month. So I appreciate you spending the time with us. As always, if you have questions about your portfolio, if you kind of have questions just about your investor profile, or if there's anything that you think that we might be able to assist you with, you can always reach out to us. We're happy to help. Otherwise, thank you. I hope you and your family have a wonderful Thanksgiving, and we'll be back in December.